Well, still with us, or rather joining us in the studio at the JSE, we've got Nick Holland, CEO of Gold Fields, is right here with us. We also have Gary Boyson and Byron Lotto is going to be joining in on this conversation. Nick, thank you so much for making the time to join us. Just going to be looking at your top line numbers. You reported a 2% drop in the second quarter in terms of your gold production. In mid-2012, you said that you were going to be embarking on a fundamental shift where you were just not going to be looking at production, but you were going to be looking at increasing cash flow. Is this strategy starting to pay off?
Absolutely, because in the quarter we've just reported, our net cash flow was $65 million. The previous quarter was $54 million. And in fact, if you go back a year ago, we've had a swing of almost $300 million quarter on quarter. So fundamentally we have shifted, even though gold prices have dropped over $500 at the beginning of last year to where we are today. So absolutely, the strategy is definitely working.
Well, Nick, usually we just talk, the two of us and you, but as it happens this morning we have Byron and Gary here, so you've got a panel to deal with. Gary, what's on your mind for Gold Fields?
I think, yeah, maybe if we can just follow on with that that thought. I mean, the restructuring of Gold Fields. I mean, obviously, if you look at it, I mean, with like you said, the gold price coming off $500. I mean, you know, the market being fairly depressed at the moment. I know you've been, you know, quite a proponent of, you know, how gold companies report their costs. I mean, I just want to find out from your point of view, where do you see that investors are going to really, you know, come back into these gold miners? Because I mean, you know, at the moment it seems everyone's preferring to hold physical rather than the miner. I mean, I'm just looking for the catalyst that's going to say, you know, let's go and invest in Gold Fields, let's go invest in Harmony rather than like a new gold platinum or an ETF. I mean, and on the back of that, is it sustainable at a lower gold price for you guys to get investors excited about these companies through these restructurings?
I think it is sustainable because the important thing that we need to do in doing this turnaround is make sure that we don't high grade, because then it won't be sustainable. High grading is mining a higher grade than what the ore body is telling us is there, which means that you're going to have a problem down the road. And the second thing is you've got to make sure you keep your development ahead of you. Your stope development in your underground mines, your waste development in your pits, and then I think you can do it. But fundamentally, gold companies now are not being reviewed any differently from any other company. We used to have a premium, this sort of mystical premium. It's all but disappeared. So now we have to compete with every other sector and every other mining company, and the best way to do that is just keep generating cash, keep generating positive returns. We set a target for ourselves of a 15% free cash flow margin. We beat that this quarter at 18%, and South Deep is not even yet at cash break even. So once we get that to cash break even, I think we have the potential to do quite a lot better than where we're doing now.
Byron?
Yes, just touching on South Deep, I understand there's quite a few safety issues there. I know you guys are setting out the foundations to ramp up production possibly next year and the year following. You're bringing in a few operators from Australia. What are your plans, and are you innovating in terms of mining technologies, especially with regards to South Deep, with less labor intensive type strategies? I know Harmony are getting quite involved and are quite vocal about that. I mean, what is your type of R&D spend on that specific innovation and that kind of potential?
Well, first of all, South Deep is a fully mechanized mine, and that's one of the first things we did when we bought the mine back in 2007. Essentially, that time they were mining the VCR horizon. They were doing all of the de-stress, which is opening up the ore body manually. We've stopped all of that. And what we're doing now is we've assembled a panel of international rock engineers to work with our local managers and the Australian contingent that's come to help us. And we're pioneering and piloting a new mining method on South Deep that could essentially fundamentally change the way we mine. And it could involve moving away from a de-stress system, which takes a lot longer to open up the ore body. You're talking about a 2 to 3 year time frame. And if we can pilot this and make it work, we could potentially be mining areas within 6 months after having opened them up. So we're going to be piloting this over the next 9 to 12 months. And if that comes off, I think that'll be the best R&D spend and thinking that we would have put in place into South Deep since we've owned it.
Nick, I think you've got 8 mines in all, and some of them are big. One, and the South Deep is the main South African. How we think about South Deep? You've just been. How are the others doing? I mean, how's the balance of the company and where the money's coming from doing?
Well, I must say the mines in Australia are doing fantastically well. Granny Smith, one of the new mines that we bought last year from Barrick. I know a lot of people were quite cynical. They're saying, what are we missing? Barrick must have sold you something they didn't want. Well, Granny Smith this quarter did 88,000 ounces at an all-in cost of $692 per ounce, which places it in the lowest quartile of all-in costs in the gold industry worldwide. So that gives you an example of how well they're doing. Tarkwa in Ghana is doing exceptionally well. We've stabilized the operations now that we've moved away from the heap leach operations. Peru continues to perform well, all-in costs of about $750 as well. So the international ops overall are generating a production of about 2 million ounces a year at all-in costs of about $1,000 an ounce. So they are highly cash generative, and we're going to be spending a lot of effort to make sure we keep them there.
Jerry?
Yeah, okay, maybe speaking of selling assets, Neil Froneman, what do you think how's he doing at Sibanye? I mean, are you any regrets on unbundling, or I mean, just your take on what they've done with those assets?
We were saying just before you came in, maybe you should have hired Neil Froneman as your general manager and kept the mine. I don't know what the market caps were when you split them, but I was just looking this morning. Market cap of Gold Fields now, I think, is 35 billion, and that puts it 48th on the stock exchange. Sibanye perhaps higher than people might think, 23 billion in 66th place.
Well, look, I'm not surprised at all that Neil has done as well as he's done, with essentially the same team that we had. And I think that was a tremendous value-creating opportunity for our shareholders. At a time when companies are coming to shareholders for money, we actually gave shareholders a scrip dividend. Now, why did we do it? We've been thinking about this for a long, long time. And one of the things that I want to put Gold Fields into for the future is only mechanized operations. And I don't want us to be in manual, labor-intensive, handheld operations, because I don't think it's sustainable. You know, if you look at our vision is to be the global leader in sustainable gold mining. And I don't think it's sustainable in this industry. I think they've got maybe 5-6 years to innovate and change, but it's going to be very difficult to do at 35-degree dip and at 1 to 2 meter stopes. You know, we've been trying for a long time to do it. So that is the one thing that we decided as a strategy, is we only want to be in mechanized mining. And that was one of the key issues behind the change. And the other thing is we wanted a more balanced portfolio of assets. We felt that South Africa was probably too large as a contributor to the overall portfolio. It was about 50%. And we felt we should be more balanced across the globe. And that's the main reason we did it. And if we were going to spin these assets out, we had to do it at a time that we felt there was still some good juice left in the orange, and I think there is. So we're delighted for them. No regrets. It doesn't change our minds, and we're going to continue to look to grow the company internationally and make sure that South Deep delivers.
So before you ask your question, every morning we try and take one phrase that we remember from the day. So today's is more juice in the orange. That's the one that we take. What were you going to say?
I'm going to make a note of that. So Nick, just to be clear, the future of mining, you'd say, is in mechanization.
Well, I would say it's first mechanization, and we need to embrace it, and then ultimately it's going to be automation. And don't think it's too far-fetched that we are going to have humanless underground operations in maybe 10 years' time. There's a lot of work happening out there, and it's not a million miles away. So we've got to position ourselves today for the future.
Of course, the South African mining industry has to deal with mechanization and the resultant labour impact. Byron, final question from you.
Yes, when you were talking about your figures earlier, you were mentioning 2 million ounces, sorry, at in cost of about $1,000 an ounce. When that South Deep asset starts producing, what sort of production do you expect from that mine, and what sort of costs do you expect coming through?
Yeah. So we're saying that 650 to 700,000 ounces per year.
So that's massive for the group.
It's huge. Is what we expect to get to by the end of 17. In other words, 2018 would be the first year at that. And we've said all-in costs for South Deep would be about $900 per ounce. Now currently it's around about $1,550 per ounce. So with extra production coming in at lower costs, it really will position the group to be well placed into the future, even at lower gold prices.
Fascinating stuff in a fascinating sector from Goldfields. Thanks to Nick Holland, who is the Chief Executive of Goldfields, for coming in this morning.